Hello and welcome. Today, we're going to dive into something called prepaid expenses. Now, I know that sounds a little, technical, but trust me, understanding this one concept is like getting a key to unlock the true financial story of a company. It's all about how costs can literally travel through time to give us an honest picture of how a business is really doing. Let's get into it. So, let me ask you this right off the bat. Can a company's profit statement lie? I mean, can it mislead you, even if the numbers add up? The answer is a resounding yes. And believe it or not, it often boils down to a simple mix-up with timing in their accounting. This is the exact problem we're going to solve today.
All right, to get to the solution, we first have to really understand the problem. And it all starts with this simple but honestly pretty flawed method called cash basis accounting. I like to call it the profit roller coaster for a reason.
Okay, just look at this comparison. On the left, you see what happens with the cash method. A company pays its $12,000 annual insurance bill in January. Boom, suddenly the books show this huge artificial loss for the month, even if they had a fantastic sales month. Then, for the next 11 months, profits look way too high because that big insurance cost is gone. You see the problem? This up and down volatility is it's not real. It makes it impossible to see the true steady performance of the business. So how do we get off this crazy roller coaster and actually see what's going on? Well, the answer lies in a really elegant and, frankly, common sense accounting rule called the matching principle. The matching principle is one of the absolute cornerstones of good accounting. And at its heart, it's really simple. It just says you should record your expenses in the exact same period as the revenues they helped you earn. It's all about cause and effect. You match the cost of 1 month of insurance coverage with that 1 month of business activity. It just makes sense, right? And this table really lays it all out. The cash basis is all about when money moves, which creates that wild, misleading volatility. But the accrual basis, which is the standard for any serious financial reporting, focuses on when a benefit is actually used up or consumed. The result? A consistent, comparable, and most importantly, accurate picture of a company's health. Okay, so if paying for a full year of insurance in January isn't a January expense, then what is it? This is where a little bit of accounting magic happens. That cash payment actually transforms into something totally different, an asset. Here's the key insight. When a company prepays for something, it hasn't actually spent the money in the traditional sense. All it's done is swap one asset, cold, hard cash, for another asset, the right to get a service in the future, like a year of insurance protection. So the process is actually super simple. First, the company pays the $12,000, but instead of hitting the expense account right away, that payment gets recorded in a new asset account on the balance sheet. We'd call it something like prepaid insurance or prepaid rent. And what's so cool about this is how the balance sheet stays, balanced. The prepaid insurance asset goes up by $12,000, while the cash asset goes down by the exact same amount. The company's total assets haven't changed one bit. It's a perfect swap. So now we have this new asset, this prepaid insurance, just sitting on the balance sheet, holding a full year's worth of value. But it doesn't just sit there forever. Every single month, a little piece of that value gets unlocked and sent to where it really belongs, the income statement. I absolutely love this way of thinking about it, a time-traveling cost. The prepaid asset is basically a cost that was paid in January, but it's held in a kind of suspended animation, just waiting to be sent forward in time to be matched against the revenues in February, then March, then April, and all the way down the line. So how does this time travel actually work? It's done with something called an adjusting entry. At the end of every month, you do a simple calculation. How much of that benefit did we use up? In our case, $1,000. You then unlock that amount, record it as an expense for that month, and reduce the prepaid asset by the same $1,000. And this little entry happens every month, like clockwork, for the whole year. The insurance expense on the income statement goes up by $1,000, and the prepaid insurance asset on the balance sheet goes down by $1,000. See? That asset is slowly and perfectly converted into a perfectly timed expense. It's beautiful. Now, this system is logical, it's clean, but it's not foolproof. When it's handled badly, or worse, with bad intentions, this whole concept can be twisted to hide the truth. So let's take a look at the darker side of prepaid expenses. There are a few common traps to watch out for. A business might just accidentally expense a whole year's contract at once, creating a bloated month and throwing all their trends out of whack. There's also vendor risk. What if you prepay a supplier who goes bankrupt before they deliver? And of course, there's opportunity cost.
That's cash that's tied up, cash that you can't use to grow or handle an emergency. But honest mistakes are one thing. Deliberate fraud is something else entirely. This quote here, it describes the heart of one of the biggest, most shocking accounting scandals in history, the collapse of WorldCom. The initial fraud that investigators found was just staggering, $3.8 billion. And that was just the tip of the iceberg. The entire massive deception was built by twisting this very concept of prepaid assets. So here's exactly how they did it. It's shockingly simple. WorldCom took their regular, everyday operating costs, money they were spending just to keep the lights on, and instead of expensing them, like they were legally required to, they fraudulently recorded them as long-term assets. They even gave them this vague, official-sounding name, prepaid capacity. With that one move, they illegally inflated their profits in their assets, turning what should have been a huge loss into a fake profit. You know, the WorldCom scandal is a chilling reminder of why understanding this stuff is so important. When you grasp how prepaid expenses are supposed to work, you gain a much more sophisticated financial lens to see what's really going on inside a company. Take a look at this. This knowledge changes how we measure a company's ability to pay its bills. The current ratio, which gives you a general sense of short-term health, includes prepaid assets. But the quick ratio, which is a much stricter test of a company's ability to pay its debts right now, it excludes them. And that makes sense, right? You can't exactly pay your electric bill with your prepaid insurance policy. So what can you do with this knowledge? Well, you've basically just unlocked a few new financial superpowers. You can now see the smoother, more accurate profit trends behind the noise. You can analyze a company's real ability to pay its bills with more nuance. You can spot potential red flags, and you truly understand the critical difference between cash coming in and out versus actual real profit. So let's end on this thought. We've seen how a simple payment can have this incredibly complex story, with its true cost traveling through time to paint an honest picture. And it really makes you wonder, doesn't it? Now that you know this, what other financial truths that we take for granted might be worth a second look? Thanks for tuning in.